All right, and we are live, folks, on Benzinga's Premarket Prep. Apologize for the delay. Spencer Israel, Joel Elconin, Dennis Dick here with you this morning. Got a lot to discuss, so let's just roll right into it here. Joel, tell us what's happening in the overnight session.
Nice rally in the S&P futures, up 22.25 points. We're weak off the open, caught a low at 31.75, pre-market high 68.50, yesterday's high 78 even. Crude in the green by 94 cents at 52.59, still in the trading range. Gold up by 270 at 1249.90, trying to permanently clear that 1250 level. Silver up by 11 cents at 14.74. Bitcoin up $40 at 33.80. Dennis, will this rally hold?
I'm the fade trader of it. I'm going to say it again. Yesterday we had a significant rally. I was saying on the show, don't chase rallies. What happened 2 hours later? We gave it all back. So fool me once, shame on you. Fool me twice, shame on me. This market has proven again and again, at least in the last 2 months, that if you are chasing the market when it's rallying 300 or 400 points, you typically are not rewarded with it. Yes, we've had a couple of days where we've had some sustained, but if you wait long enough, it seems to come back in. It seems to always give you a second chance. I don't think we're out of the woods. I think we're in the middle of the range, and I'm going to keep playing the fade trade until it doesn't work anymore. So I'll just say the market is guilty until proven innocent. We are up, the 25 handles here this morning because Trump's talking a little bit nicer. We got the release of the person there over in Canada. So it's talking nicer here right now, but not out of the woods. That's what I'm saying. So I'm keeping the fade trade on. The fade trade is just basically selling rips and buying dips.
I would like to see an inside day here, a quiet day, and then a breakout to the upside. That's what I'm looking at, just not these crazy sell-offs and bounces. And I mean, we must have had, 70, 80, 90, 100 point SPOO range if you take out all the up and down. So I'm looking for the average daily range to calm down a little bit and then have a little move to the upside.
So I'm just sticking with the same theme.
Okay.
We did get a sell-off yesterday. If you believe the lows are in, yesterday, last night would have been your opportunity. Today, not so much because you're ripping back up here again. So could we continue? Could we go up 500 points? Sure, we could continue. But I'm just not going to, be buying here when we're up to 250 points because I think I'll get a second shot again. I don't think we're out of the woods. I mean, I look at Deutsche Bank situation. You look at Brexit. There's so much going on. You don't know what the Trump next headline is going to be. I mean, eventually we're going to get a deal with China, and then maybe we're going to really have that rough rally. But, I mean, we still have so many I'm still going to say, which we haven't talked about for a while, is Deutsche Bank. This thing is at $8.52 here this morning, closed at $8.33 yesterday, getting a little bit of a lift, but you're looking at a stock that's at 20-year lows, or I don't even know if it's all-time lows. Like we said, Joel, our charts don't go back far enough to see the price this low. There's some serious problems here in Europe, and I believe they are going to go into another financial crisis here, at least over in Europe. You can just see it from the banks. They're not rallying. And I believe our U.S. banks have shown a lot of weakness, just because there's concerns of what is happening. And obviously, if you have problems with Deutsche Bank, you're going to have problems with the rest of the European banks. And they're probably going to have problems with the rest of the banks in the U.S. as well, because they're all in bed with each other. So I think that's the wild card to think about here. So if you come in here buying hand over fist saying the bottom is in, I don't believe that yet. So I'm going to just say guilty until proven innocent again, keep my sell the rip hat on and buy the dip hat on. I'm probably not coming in here and selling this, rip with, two hands this morning, because we did get the sell off yesterday. We didn't make new lows on the move yesterday, so that's the good news. I think Trump is defending this market right now. He started talking a little bit nicer because he sees the market down, giving it back. He doesn't want the market down because it's obviously bad for his numbers. So I think, you do have that working for you. So I'm kind of still, doing the fade trade, but I think I'm a little more prone maybe to buy the dip right now than sell the rip if you're just looking at which way I'm leaning. But again, fade trade and not chasing has been working.
Okay, let's go to some of the news here. We do have some earnings, and have you not been going to Dave & Buster's much, or what is going on with that?
I've never been in a Dave & Buster's. I've always wanted to go. They say it's like what they call like a Chuck E. Cheese or whatever for
No,
adults or something. Isn't that what you call it, Spencer?
That's what you call it. I've never called it. But you called it.
That's
Is that what I call it?
You
No,
I made
that's
that
what
up?
I call it.
Oh,
Calls it Chuck E. Cheese. So that's where I got that from.
right.
Have you been in one, Joel?
No, and I never will.
We've labeled it. Neither of us have ever been in one.
I've been in one. There's one near me. I've been in one.
Is it Chuck E. Cheese for adults? Can you confirm, Spencer Israel?
Yes.
Is Play Chuck
Yeah.
E. Cheese for adults?
It's a fun place. If you're
What's in there? Like games, beers.
yeah, it's
Like-
a bar with an arcade attached to it. That's all it is. It's a bar and a restaurant with an arcade.
Well, whatever. It's not doing well here this morning, so it's not fun for Play here this morning as the stock's trading down 12%. Give us the details on these numbers.
Yeah, not a bad report by the headline. The Q3 EPS 30 cents beat a 24-cent estimate. The sales of $282 versus $277 million both beat. They did narrow the range in their fiscal year sales guidance, but it is still in line with estimates, and they reaffirmed their comp guidance in the low single-digit range for the year. So nothing, they didn't lower anything. They didn't really miss anything. It's all pretty much a beat and in line. I guess it just wasn't good enough here.
And stock trading down significantly. And like we said, Joel, you got to find us some levels here because we got to go to the weeklies. I see those 46 lows, but it's well below that. Now I see a lot of air below there. This isn't that pretty.
I could just give you a range on this one, and because you had a bad looking 45 minutes after the number, and then you came down and you made a low in the 42 handle at 42 even. But since that panic low, someone's stepping up at 43 here, and I'm just basing this on the 15-minute chart. If we can show that. Just over the rest of the after hours and pre-market session, someone's just been nibbling around 43 bucks, 43 and a quarter. Now they've stepped it up. So I'll just call 42 and a half to 43 range. If it comes down there and I'm short, I want it 44, 44 and a half, 45, 45, 60 has been the top. But just when you see a 15-minute chart like that, someone's trying to bring stock in at 42 and a half, 43.
Also reporting earnings last night was American Eagle Outfitters, and it is getting hit here as well. So not a good day for retail once again. I mean, you talk about stocks that have not really been participating in any type of rally, not that we've had a huge rally, but you look at the Kohl's, you look at the Nordstrom, you look at the Macy's, all sitting on the lows. I mean, if you're a believer that December is their best month and there's a Santa Claus rally coming, well, these retailers are on sale. AEO Q3
EPS 48 cents, in line with the estimate. Sales of 1.004 versus 1.02, so essentially in line there. It's a miss by a hair on the sales, but they're more or less in line for both Q3 numbers. The Q4 EPS guidance was light. That's a problem. 40 to 42 cents is the range they gave. 46 cents was the estimate. They gave their Q4 comps guidance growth in the mid-single digit range, and total sales growth for the current quarter, Q4, in the low single digits. Their comps for the last quarter, Q3, were up 8%. That's a good print, but the miss on the Q4 EPS guidance is, I think, what's driving us down here this morning.
I'm not a fan of this or the Gap. These are two stores that I haven't been a fan of for a long time. Obviously, in the summer, I was proven wrong because the AEO kept going straight up. But I don't think I've been on the AEO bandwagon forever. I don't know. I'll just leave my comments at that. I mean, it's down good this morning. I think if you get any rallies on this thing, I think it meets more sellers. So I'm not a fan of the store, and I'm not a fan of the stock.
As opposed to the Dave & Buster's chart here, we are sitting at the lows of the pre-market session, and we're only knots away from it. So big buyers you did in the other stock. 1740 is your pre-market low. 1749 is your last print. So if in fact you do get that, you have no monthly support until your February low of 1614. But if in fact we busted that 1750 or that 1740 low, you could see some potential shortcoming or institutional bids at 17 even and under 17. I don't think we're going to see that 1614 today, but as of right now, showing no life at all in the pre-market trading.
I mean, we got Sophicals in the chat there just saying AOSP 9.5 times trade, 9.5 times earnings. I mean, these things are all cheap for a reason, though. That's the problem, is I don't think the growth is there. So if you come in here saying, yeah, these things are going to turn around, I mean, you're banking on a turnaround story. And I don't think that these things have the growth. And I'm going to throw the Gap in that same category. They have the old Navy brand GPS, but I'm just thinking it's similar to this. And I'm not a fan of that one either. Jump over one more earnings report there. We'll go to from last night, First Solar, FSLR, a stock that I'm interested in buying in my long-term portfolio. I've been interested for a long time. Goldman was bearish, then they went bullish. I'm trying to wait for our buddy there to see what he's been bearish for a while, but I don't think he's changed their Gordon Johnson is who I'm talking about over at Vertical Research, because he always seems like the best on these. And when Gordon comes out, is he still got a sell on this First Solar? As of last we saw,
I think as of last I can remember, yes, but I haven't checked.
Check in the background, Spencer. Give us the numbers first. I'm going to send you just checking what Gordo's rating is on this, because I'm following, just like I follow Inch on GE, I'm following Gordon Johnson on First Solar. When he says buy, I'm going to buy.
Well, the most notable thing that I saw was they gave guidance. I don't have the earnings for some reason in front of me. I'm trying to pull those up right now, but the guidance they gave for the fiscal year EPS was in line with estimates at a range of. Where was my page here? I apologize for not having the numbers in front of me. The range was 2.25 to 2.75 was the range they gave for the fiscal year EPS, and that is, like I said, that's actually a little bit light. 291.
Yeah, because 265 was the estimate.
291 was the Reuters estimate, and the revenue guidance for the year was a little higher. However, 3.25 versus $3.45 billion. Versus a $3.02 billion estimate. So they came in a little mixed on that fiscal year guidance. I don't know why I don't have the numbers in front of me, though. So I apologize.
He's got a hold on it, Dennis. He's got a hold on it.
Well, he's not at a sell anymore. He's at a hold. Did he upgrade that to a hold? Or was he? Because I thought he went to a sell for a while, didn't he?
He did.
He's very active with his ratings. Gordon changes quickly.
You gotta he went to a sell. And at 55, 53, and then he went to a hold here at like 46.12. Really one level of interest here, and that's the $42 area. You came up hard off the October low, and since then, someone's just really been, or institutions or retail traders really like this $42 level. It did not get down there yet, but just a level of support, eyeballing it too. It looks a little bit above the 50%, but we'll see what happens at $42 here in First Solar.
The one thing is I don't like this chart. So I kind of, I'm interested in putting some solar in my portfolio. Obviously, I'm looking at Gordo for guidance there, so we'll see if he's ever going to go to a buy rating on it. But this chart does not look good. When you've hung out here at the lows for this long, it makes you think eventually you're going to take it. It does today on these numbers. Rally and get away from that 42, maybe it's got a chance. But I tell you, if it ever takes out that 42 low, which Joel's talking about, that triple bottom, Katie bar the door, we're going to see this thing at $38, I think. So I'm scared. I'm too scared to buy it, and I would actually be leaning, even though I kind of want to invest in it. I would actually be leaning if it took out that 42. I might even try from the short side. So you got to be able to just flip the script, and if 42 goes, I would say that looks like a nice setup for me.
All right, one thing I wanted to get to before we get too deep in the weeds of our show today is the futures rollover, and I know you guys wanted to explain a little bit about what that was, because we do talk about it sometimes on the show. We mention the rollover in contracts, but we don't really explain what that can mean. So do you guys want to go into that right now and explain a little bit about what that means?
Yeah, sure. Well, the rollover is a precursor to the quad witch. Which is the third Friday in December. And as you know, that can be turning points in the market, as we saw with the September expiration. Actually, on the Friday of the September expiration is when the market made its all-time high. So we've been trading the December contract. That was definitely a turning point in the market. And now the second Wednesday of every month, Institutions, traders start to roll over their contracts from the December contract to the March 19 contract. Financial futures only trade March, June, September, and December. So what happens is if you are long to December, and you still want to be long to March, you need to sell your December and buy the March simultaneously to keep that position. On the flip side, if you're short December, you got to buy the December and short to March. So what this does in the bottom line is it spreads liquidity through two as it rolls over. So you get these air in the market because you don't have equal liquidity in the main contract. And that's what exactly what you've been seeing in this market is air pockets as they are jockeying and there's an actual spread, and the spread will actually be zero on expiration. But over the years, I know some guys on the floor, some of my buddies, they will not even trade the day before rollover, the day of rollover, or the day after rollover. So tomorrow officially we'll be trading the March 19 contract, but there's a lot of air pockets in this market because you are spreading the liquidity between the December and the March 2019 contract.
Okay.
Nice summation.
That was
Let's jump
good.
over another news here. And I wanted to mention this Spencer Israel hat tip to you, but the low in GE yesterday, 666. Do you know what the S&P low was, Joel, during the financial crisis?
Yeah, we all remember that.
You've only said it 100 times.
666. Is that a coincidence or is the GE low in? I'm asking you boys. Do you think I'm asking the chat too. 666. Could GE bottom at the exact same price the S&P did back during the financial crisis? It'd be a good story. If it did.
I would say no.
I would say no.
Me being a strong trend follower, I still think you just got people just yakking this out of their portfolio. And so I just don't think you can look at this thing until December. And usually when this bottoms, it's usually not at a weird number like that. It's usually like, let's say 650 or 6 even or 550 or 5 even. That's where you usually see the institutional bid. So it's above that right now. 430. It's definitely a level to lean on, but I don't think it's going to be the ultimate low.
Hat tip to colleague Brent Slava, because I couldn't remember who it was. Mark Haynes, right? That's the guy who called the 666 bottom in the market back in 2009.
Yeah, the CNBC,
right?
The founder of Squawk Box, I believe it was.
Right.
Mark Haynes was. I always enjoyed watching Mark Haynes, and I actually miss watching him. Obviously died, but he was always the best with interviewing because he'd get on with those CEOs and he would ask anything, and he was such a tough. Like, you had to be scared when you were getting interviewed by Mark Haynes, because if you got caught up in your words a little bit, he would just attack you. And you don't see that usually. You see everybody kind of kissing their butt when he gets a guest on. They're being super nice. Mark Haynes would attack these CEOs, trying to get stuff out of them, and they'd be up there almost shaking in their boots. So I actually liked the way he interviewed there. I got a kick out of it, but also, he kept them honest.
I bring it up just because he famously called the bottom, and so is this the Dennis Dick bottom in GE here?
Yeah, maybe. Well, I hope I don't die at 5 years. But anyways, Mark Haynes, though, great. He did a great job for so long. And yes, he did. I can remember actually what he said was, I think we're going to bottom in the next couple of days. So he didn't say 666 was going to be the bottom, but it was rate trading down around 680. He says, I think we're going to see the bottom here in the next 2 days, I think is what he said. And it ended up being 106. So, fun fact is, though, for Mark Haynes, is he actually wore, I am Mark Haynes. He actually wore jogging pants to work every day. So he had the suit top on and jogging pants on the bottom because he wanted to be comfortable. So he would stroll into the NYSE and with his jogging pants on, I think the Squawk Box is being filmed still from there, stroll right into work, with the suit top on and the jogging pants on the bottom. Must have been funny. People walking down the street. He must have got some interesting comments, but he just didn't care. He wanted to be comfortable doing the jogging pants on the bottom and the suit on top, and that is just awesome. And I feel like I do that some days too.
You do not wear
and
a
I
suit.
think Joel and Spencer can verify that I do that some days.
But you don't wear a suit on top. You wear just a.
No, I don't wear a suit on top. I wear a nice sweater, or not even nice sweater sometimes. But sometimes I've got the pajamas on.
Right. Exactly.
Pajama man, pajama trader.
Pajama traders. Isn't that what Doug Cass always calls them? Pajama traders. I'm one of those pajama traders.
All right, we're coming up here on imbalances here, and we will do that.
Hot off the press right now. Let's see what's up. What's up? Balances. What's going on? We've got GE. Oh my goodness, it's a shocker. GE 274,000 shares to sell as always. We say that every single day. And look, and then you know what? It sells off. I mean, this is not clockwork. The thing's at 690. It sells off a nickel. There's that sell balance every day, guys. Every single day for like 2 years has been an institution selling 200,000 shares. They must have been the biggest holder ever. Morgan Stanley 68,000 to sell. That was downgraded by KBW overnight, so that's why it is trading, or at least showing a little bit of red here on the screen. Well, it's trading up because all the banks are trading up, but it's giving back a little bit here as it just showed that imbalance. Alibaba 39,000 to buy. We know China had a nice rally here overnight. Wow, they're small. That's about it. Square 20,000 to buy. Taiwan Semiconductor TSM 82,000 to buy. They're pretty small.
Okay, all right. Everyone wants to talk about NVIDIA here. SoftBank is selling their 4.4 stake of 26 million shares. I mean, who knows where they're long from here? They are hitting it on that news. Boy, they sure waited a long time to sell this, trading down $1.28, trading at the lows of the pre-market session. Still kind of hanging out near the lows. If you want to fade SoftBank here for a longer term swing trade, pick it up at 146, 147 and change. Ooh, that's 14 points above the low of 133.31. Dennis, any thoughts here on NVIDIA?
Trading in the red. And is this the only headline here? Because this was green just that, and I got that headline last night. So this headline I thought originally broke last night, and NVIDIA was trading up 1% here just about an hour ago, and now it's turned red. I'm wondering, I know it was cut at RBC here too, but that was at 7:30 this morning, and since then it had traded higher. I'm wondering if there's any other headline or if it's just that one, but NVIDIA's turned to the red. And remember, yesterday when we lost the leaders, that was your tip-off. Not that NVIDIA is a leader, but it still kind of is. I mean, Apple's been your leader. But if we look at the trading action yesterday, and this is what you've got to do is, you want to look under the hood. You want to read the tea leaves. You want to, find out, when you're seeing a market rally, look at the components. Look at the major ones. What are they doing? I will tell you, and I tweeted it out. Apple started going red. Square started going red yesterday. NVIDIA started going red yesterday. The Qs were still up 1%. That was the tip off. And you know what? In the next 20 minutes, half an hour, we started sell off substantially there. When you lose your leaders, often the other stocks will start to follow. So keep that in mind. We've lost NVIDIA apparently already here today. We're okay on the other ones when I look under the hood. But just keep that in mind. We're up, pretty good here this morning. We start losing some more of the leaders. That could be a sign that this rally might fade. So always when you're trading, especially as a day trader, you've got to be watching for any tip-off you can get from some of the market leaders. And NVIDIA going to the red here today is not good for the overall market, but I'm not concerned until we start losing a few others.
All right. You think the all-time high is in NVIDIA? You think whatever? Yeah, you do?
You can't say high might stand forever. I'll never say that. I think you're going to see NVIDIA, to get back there is going to be very hard. And it's out of favor now. So you got to start thinking of it as normal valuations. I mean, a lot of these semis are trading 8 or 9 times. NVIDIA, I think, is trading around 20 times. So it's starting to get reasonable, but still trading with twice the valuation of some of the other semis. So when you think about it that way, it could have more room to the downside. But I get interested for a trade if it was to test the 133 low. So if it can get down there, I'm not saying it's going to get there today. It's a long ways away. But, if it sneaks its way down, back down there, maybe we get another market sell-off. If it gets down there to 133, I might take a shot at it. But obviously, if your breach is that low, then all bets are off. I don't like stocks when they're making new lows. I always say when a stock makes a new low, you got to go. AMD, another story here, and you know what? I'm starting to lean to the side that I think AMD might eventually take out its lows of the move too, which is way down at $16.17. So I think I'm a seller of rallies in AMD as well. But I mean, if you are in the bull camp, the level you absolutely need to hold, in my opinion, in AMD is 1917. That was low from 3 days ago. We don't want to see it take that out. It takes that out. I think it's back down to 17 handle.
One interesting thing about AMD is when you had that rally. We talk about gaps in the market, and I know there's a lot of people who just are specifically gap traders, but you had that gap down in earnings, and boom, boom. You went and you had a gap between 2015 and 2272. Well, you got through it by a little bit. You got to 2375, but it's been south ever since it filled that gap. But Spencer, you want to take a break and bring our guest in?
Sure. Today's guest is Chuck Self, the CIO of iSectors from, I want to say, Appleton, Wisconsin. I think.
And you are correct.
Okay. I will be right back in a moment with Chuck Self. And as promised, here is Chuck Self, the CIO of iSectors. Chuck, how's it going this morning?
Great. Everything is good over here in Appleton.
Excellent.
Yeah. How's the weather?
It's cold, just like it is, I'm sure, where you are. A little snow on the ground, but I think we'll have a white Christmas, but at least it's not like in North Carolina.
All right, a little volatility here in the market. You can attribute it to a lot of different things here. I know you were cautious on the market last time we spoke to you, but
Yep.
you sent over those 3 interesting charts and some interesting perspectives on the market here. So why don't you just we'll start with your first chart here. Let our your thoughts on the market.
Well, again, like you said, back in July, I had indicated that we were cautious of the market that should bonds. Obviously, I was early on that because the market continued to run up into September, but it has really paid off here this quarter. Our primary strategy is the post-MPT growth strategy, and it's almost 75% in bonds, utilities, real estate, and gold. And of course, all of those sectors have done well this quarter. And so let me ask you guys a question. And this is not a trick question. It's a good question. What makes the ugly beautiful?
What makes the ugly beautiful? Beauty is in the eyes of the beholder. I don't know.
Very nice, very nice. Actually, it's gold that makes the ugly beautiful, according to Moliere, who was a French playwright. And of course, the market's been ugly, but precious metals, and especially gold and, well, palladium also, have made the ugly beautiful. The precious metals, gold is up almost 5% this quarter when the market's down, what, 10% this quarter. And so we think that both traders and investors should be looking at gold. And of course, you could trade that with gold bullion ETFs. SGOL is one, GLD, so on and so forth. And so usually in this part of the economic cycle is a great time to buy gold, and that's the chart here indicates. As the 5-year to 2-year Treasury flattens and gets close to zero, historically, of course, that means that we may be going into a recession. And historically, as it gets below zero, which is what that purple line is, that's when gold really shines. And so that's a good time to look at gold. If you put up the next chart, and that's the industrial production chart, hopefully, you'll find that industrial production, of course, is a good coincident indicator of activity. And when the change in industrial production goes negative, then gold prices tends to continue its rising trend. So in fact, when you look at the 2000-2002 recession and the 2007-2009 recession, gold and precious metals were the only investments that gave you positive return. And then finally, when you look at what's happened with stocks historically, again, stocks, of course, tends to turn down before recessions, but gold continues to go up. So why am I talking about gold and precious metals? It's because my belief is that financial advisors and investors are under diversified going into this part of the market cycle. We've made so much money on stocks. And so for people, for their longer-term portfolios, they got to diversify. And bonds, of course, are okay, but precious metals are the true diversifier over time. And so, and then, I'm not a chartist, but the chartists tell me that you look at gold, it looks like it has the ability to break out here. And it's something that listeners should be focusing on.
I mean, I'll give you that, Chuck. The gold chart, so some life. I do have some silver in my long-term portfolio. I have very little gold. I've been underweight precious metals just because I don't feel like they had the luster that they did, just even what you started with when you said what makes, the ugly, beautiful gold. And this was the mind frame 25 years ago, or even, 30 years ago. But you don't see the younger people really wearing a lot of bling bling or fancy jewelry. It doesn't have that luster that it used to. And I think that's concerning in the long term for gold, because I think when we look 30 or 40 years from now, there's not going to be as many people just interested, because I don't think these younger people like wearing gold.
Well, that's certainly the case in the U.S., but when you look at Asia, still gold is huge in Asia, and of course they got seasons for that in India and China probably. For that. But again, it's the investment demand that is the real marginal demand for gold here. And it is such under-owned by portfolios, and that it once people start deciding, stocks are not just the one-way ticket up anymore, and they start looking around, they're going to look for gold. A year ago, people were saying, well, gold is an ancient metal, and Bitcoin is going to be with the new thing that's going to supplant gold. And I think we can put that argument to bed.
I mean, I don't think that the Bitcoin and the gold have any relationship at all. I've never been a fan. If you listen to the show, I've never been a fan of Bitcoin or any cryptocurrency, but that's a different story. I just get concerned that the same reasons that people were buying gold 30 years ago maybe don't exist as much today. The safety trade, people say, Kramer says all the time on the show, 5% of your portfolio's got to be in gold for insurance. But really, when we look at the performance of how gold has performed, has it really played? It does. In the recent last, month or two, maybe, because it's caught a bid, but I just don't know if the safety trade's there anymore either. So just my own personal opinion is I'm just not a huge fan of the long-term prospects of gold. Short-term, though, you've got the chart. It is in an uptrend. So I would say you've got a potential trade here still from the upside, because gold still looks decent on the charts.
And I will agree that the reason when you look at this chart here, and the reason why, of course, it went up into the highs in the 1980s, the gold is in blue there, was the inflation scare at the time. We don't have an inflation scare. So this is purely a diversification play in saying, if you have the belief that the market is going to go into a deeper correction or maybe even a bear market, it's a place to hide. Yes, cash rates are up, but yields are still pathetically low, and in fact under the inflation rate that was printed this morning. So I'm not saying people should put large percentages in there. I just think it's under-owned, and it's something that people should look at.
What about gold? They've been serial underperformers. It seems they used to move really, really well, with the bullion rallies and declines. You get a little dividend with them. Are gold stocks any way to play the potential gold rally? And if so, which ones are?
Yeah. Now, we play sectors, so we own the GDX in gold stocks, and we own it in our post-IPT growth strategy, our tactical strategy. We have a small position, about a 5% position in it currently. So it's not the largest that we've ever had. Right now, I agree with the right thing to do. Our precious metal strategy that has gold, silver, palladium, and platinum is actually up for the quarter. And that has been certainly the best play of the quarter. And, it's just that I was looking around, just to see articles on the internet about it, and it just hasn't been written a lot in recent months, even with the rally. And so I thought, this would be maybe something different that the listeners would like to look at.
Okay. And you mentioned in the 80s, I believe it was the early 80s, when gold, had that major run up. A lot of it was associated with inflation. I think right now you have the market really trying to decide whether or not, we're flat out going into recession. You don't hear as much talk about, runaway inflation. Are you looking at this call in the gold market independent of the lack of strong inflation?
Yeah. I'm looking at it more like the rallies that took place in the 2001, 2002 recession and the 2007 to 2009 recession. It's just being a place of safety. I actually believe that the 2% type inflation that we're seeing is going to be the top in the near term. We're actually long bonds, so obviously we don't believe that inflation is a threat to the economy. And although we haven't published this, so this is new news, we think that the next recession could start in the fourth quarter of next year. So we think we're that close to a slowdown between having the Fed tightening and all the lags with the Fed tightening, the negative wealth effects with the stock market going down, the fiscal withdrawal pretty much over. We think that the economy could get down to zero growth by the end of next year. And then just before we go, I also think people should be looking at the oil charts. It has the possibility of breaking out, and this is a seasonally strong time for oil. And so I think that people should be looking at VDE and other energy sectors.
All right, Chuck Self, CIO of iSectors. Chuck, as always, thanks for the time, and have a good week.
Yeah, and you guys have a happy holiday.
Yep, you too.
Okay, Dennis, another scenario here. SPOs are ripping north.
Yeah,
now
they
we're
are.
up 31
Yikes.
handles here. And nothing up here, man. We're back in the 70 handle. And boy, oh boy, 75.5 was your intraday high. And what I mean by the intraday high is that takes place only between 9:30 a.m. Eastern Standard Time and 4:15 p.m. Eastern Standard Time. So your intraday was 75.5. And then the Globex high, the 24-hour high was 78. So I don't know if I want to give you two highs there, but the ultimate high for me, the ultimate target would be 78 even. And that was Tuesday's Globex high. And we are only 5.5 points away from that. Who would have thunk it, Dennis?
Yeah, well, who would have thunk it? I mean, all we've seen is up 300, down 300 Dow points every morning. So I think everybody would have thunk that we're going to have more volatility. You know what? Look at the ranges. We're going to have these ranges, guys. So you look at yesterday's range size yesterday. We might as well do 50-point range, or so 50-point range yesterday. Day before we had 50. Let's call almost 65 points. And you can probably do this fast with me, Joe. I'm just eyeballing it. Looks like 80 points the day before. These are the daily ranges. So, for us to move 10 handles is nothing in this market right now. People ask, and I got a reporter calling me yesterday, why so volatile? Why do we have all this volatility? Well, there's so much market uncertainty out here. There's so much volatility. When volatility starts, market makers have to back off, because you can't sit in there and make tight markets for a penny in this market, because you get run over. Market makers and your liquidity providers, it's like picking up, nickels in front of a bulldozer. And if the bulldozer is moving really fast, you've got to start not picking up so many nickels, and you got to start only picking up the quarters. So market makers, are typically going to be backing off during this environment too, which leads to more volatility. Once, we get some more certainty, once the volatility calms down, then you'll start to see liquidity get a little bit thicker. Market makers start to tighten up the spreads. It's all electronic market makers now. But if you look at the spreads at 10 minutes into the day, you're seeing spreads typically much wider than they were 3 months ago. And that's because electronic market makers are backing down. If you have less liquidity in the market, stocks will move more. So it's still uncertainty. We don't know what the next headline is going to be. I said it yesterday on the show. It's headline driven. It's new headlines every single day, and it's going to continue to be the way. until we get some more, confidence and some more certainty in this market. We've got a real big battle between the bulls and the bears. A lot of people believe we're going to have a Santa Claus rally. I got to get positioned because this market's, going to eventually go up. And maybe it is. But I will say it is very difficult to predict this market out anything more than a few hours right now. So I'm not going to even try to say, yeah, we're going to be, much higher or we're going to be much lower. I'm just going to keep playing the fades because the fades have been working.
Two things here. One is a 9-day average trading range as kind of like an indicator of, everyone uses the VIX. I use the average trading range. When we were just climbing north, earlier in the year, those incremental days, I think we even got to the point where we had less than 20-point average daily ranges, and we just grinded higher day after day. And then, obviously the volatility comes in and changes things. I mean, you can look at, for example, the monthly, monthly ranges, have been 60, 70, 80, 90 points. That would have been a monthly range. That I'm looking back in November of 2017, that was a big monthly range of 103. And, but now, now you're having 200-300 points. So I definitely like to see the volatility come down. And then talking about the predictability of the markets, remember what Eddie Franco used to say? He was one of the founders of Bright Trading, and he was originally involved with a lot of the market makers, Blair Hall of Hall Trading, and I don't know if Interactive Brokers was back around then, but Blair Hall, one of the world's most famous option traders, he, on all of his analysis, and this is back a long time ago, he said you can only predict the market 7 minutes out. That's as long as you can go for predictability, and that comes from one of the world's most experienced.
There's a lot of truth to that statement, and this is probably why I'm such a short-term trader, and I can see okay, there's somebody buying right now, and then they're not selling. And I've always played the modes or played the little intricate little moves, but I've been much more successful a few minutes out than I have probably a few days or a few weeks out. I think I do an okay job trying to predict it out, but it's kind of a coin flip. I mean, if you're where we're going to be tomorrow, where we're going to be next week. And in this market, it's a complete coin flip. Anybody who says they know what's going to happen, walk away. Nobody knows what's going to happen in this market. But in the 7 minutes, in the next few minutes, you can actually predict the market. And this is how, I've been consistently profitable every year because I'm always taking short-term trades, and the momentum starts turning. You know how quickly it starts going in one direction. It's like, okay, like yesterday, you start playing the short side after you lose Apple, after you lose Nvidia. It's like, okay, you know what? We're starting to lose some of the market leaders. They're probably going to start selling the other techs. That's going to bring down the index. Those are the little things, or, like the pairs trading that we do, some stock rips. Okay, well, this one's going to rip here too. We can predict that's probably going to happen here in the next few seconds. I say I probably predict what's going to happen in the next few seconds better than I probably do 7 minutes out. But it's such an interesting quote. I don't remember ever hearing that one. So thanks for sharing that, Joel, because I completely agree with that. Very difficult to predict this market out, much farther than, a day or two for sure. But in this market, that 7 minute rule might apply.
All right. We just came within 1 point of yesterday's high. We just printed 26.77. Yesterday's high, 26.78. Above that, if you're looking for more of a target, and this is going back a long way. Last Thursday's close was 26.91, so there's a little bit more for you. Did we cover all of our ratings? I know that there was the bank downgrades. Did we miss any of them?
Yeah, there's one that I want to hit on this morning. That is Verizon. So there's a rating, and there's also another headline from yesterday on Verizon. So the rating this morning is they're being downgraded at Morgan Stanley. To equal weight, they announced a $58 price target. This is purely based off of valuation. And the other headline from yesterday is that almost a year and a half to the day that their acquisition of Yahoo closed, Verizon is writing down essentially the entire value of that acquisition on their balance sheet. They are initiating what is the number here? $4.6 billion value impairment charge on their
for the Yahoo acquisition.
Well, it's it's the Yahoo, and it's for the Oath, which is like the media brand. So it's the AOL and the Yahoo like arm of the company. Because remember, they also bought AOL for whatever $5 billion a few years, 2015, I think. So, but they paid $4.5 billion for Yahoo a year and a half ago. That is when that closed. And yesterday they announced a $4.6 billion write down on their media on their media business. So they're
Is that
essentially
possible?
so they're essentially writing down the entire
They have to be the worst two companies at acquiring other companies. They buy everybody. Who the hell's buying Yahoo? They bought Yahoo a year and a half ago, and you got to scratch your head. You know what they were paying for these assets. The only value in Yahoo, I said all the time, was their Alibaba holdings, and they bought those other assets. They're writing part of it off a year later. Who's running this company, and who gives them the valuation that they give them? You know, Verizon trading up here $58, you know, or whatever, $58.85 to close. Good call by Morgan Stanley on a valuation on this thing. I can't understand why they ever did that acquisition in the first place, and to write it off a year later. Some people need to be fired for something like that. Whoever's like saying, come in here and buy Yahoo assets at at basically market value or above market value, and then writing them off a year and a half later.
That's horrible.
June.
I mean, that is.
AT&T buying DirecTV right at the top. AT&T, I challenge a Time Warner deal here yet. So I don't know. These AT&T and Verizon just don't know what the hell they're doing when it comes to acquisition. That's my opinion.
June 13th, 2017. It was the date that their acquisition of Yahoo closed, and that is almost a year and a half ago to the day. That they are already writing down basically the full value of that.
That's incredible.
Of the Yahoo acquisition. So,
you know what? That's an interesting price target, because it's right here at 58. So, I mean, they're not saying shorted here. I mean, they're actually giving. Well, actually, it's flat here at 58.85 here. So I think that's interesting. I think we'll see. 58's a little rich. It's holding up here. Well, actually, I see it down 75 cents. So right at the $58 area, your 2-day low is way down at 56.87. But I don't know. This has me, just the fact that they're writing it down, this has me thinking about a little bit of a longer term short here in Verizon. But all right, 9:01, Spencer, you want to wrap things up and preview Thursday's show?
Sure. If you missed any part of our show today, you can catch our podcast. That includes our interview with Chuck Self. It's on iTunes, SoundCloud, Stitcher, TuneIn, and Google Play, or just watch us on YouTube. As far as tomorrow's show, we are going to be joined, as we are every other Thursday, by Mark Chaikin from Chaikin Analytics. Thanks to Chuck for joining us today. Thanks to all of you in our chats, both on YouTube and premarket.benzinga.com. Please remember, all the information from our show is for informational purposes only, not meant to be investing advice. And on that note, everyone, have a good rest of your Wednesday, and we'll see you tomorrow.